Now time to bring you the latest from the world of business. We now start off with the Lagos Chamber of Commerce and Industry, which says that the Central Bank of Nigeria's decision to hike the monetary policy rate will not yield the desired result of curbing rising inflationary pressure on the economy. The Director General of the Lagos Chamber of Commerce and Industry, who made this known in reaction to the MPC's decision made in the recently held meeting just yesterday, says that supply-side factors like foreign exchange scarcity, insecurity, rising cost of petrol and diesel, as well as weak infrastructural support for production must be addressed first. According to her, a comparatively low interest rate could make the country's portfolio assets less attractive to asset buyers and offshore investors, as this could also make the economy suffer greatly from massive capital flight with a negative effect on the exchange rate. The LCCI DG, however, urges the CBN to maintain its targeted intervention schemes for agriculture, manufacturing, industries, energy infrastructure, healthcare, exports and the MSME sector to sustain current economic growth. And now, in a related development as well, the Manufacturers Association of Nigeria is lamenting what they've described as quite a difficult situation to have to maneuver through, talking about the tough operational stance we have in the country, where we see businesses shut down or have reason to relocate to other neighboring countries, which is constraining the sector's growth. Addressing journalists at this year's CEO's breakfast meeting of the Manufacturing Association of Nigeria Ikeja branch, the president of the association, Mansour Ahmed, explains that the country's operating environment is characterized by overregulation, high production cost, foreign exchange scarcity, unfriendly policies, infrastructure deficit, among others. Now, Mr. Ahmed, who was represented by the Vice President, John Aluya, urges the government to also gently intervene so as to hinder further closure of more industries across the country.
The operating environment now is very, very challenging for manufacturers. You are talking of high cost of energy, that's diesel and all that. And in the first place, for the manufacturer to leave their own specialization, which is producing goods, to start generating power is already an abnormality, okay? And this is an extra investment that should have been used to develop the manufacturing process itself.
All we ask for is the cooperation and understanding from the government so that we can continue to manufacture. We need to sustain our manufacturing, and to sustain it, we need the government to give us the right environment. The biggest challenge we face is complete absence of infrastructure. If you don't have an infrastructure, there's no way you can manufacture.
With regards to competition against foreign imports, there needs to be some protection for our domestic industry. Remember again that we are going into the AFCFTA regime. So with the Africa Continental Free Trade Area Agreement, you'll find out that we'll get offshore players from other African countries coming here to play as well. So our manufacturers need to ensure that they protect their turf.
Now shifting focus to the power sector, reports from the Federal Ministry of Power states that Nigeria's power grid has collapsed again for the fifth time this year, crashing from the 3,921.8 megawatts that was generated as at 6 a.m. earlier yesterday to a low of about 50 megawatts around 12:23 p.m. the same day, causing widespread blackout across the country. According to the report, power generation on the grid has continued to fluctuate due to various concerns such as gas constraint, water management challenges, and gas pipeline vandalism, among others. Meanwhile, the Transmission Company of Nigeria notes that their teams are working on a possible restoration. It will be recalled that the nation's power system collapsed twice in the month of March this year and twice later again in April this year. And now shifting focus to the capital market, barely 48 hours after the Monetary Policy Committee of the Central Bank of Nigeria announced its decision to raise monetary policy rate to 14%, the Nigerian equities market extended losses for the second consecutive session with 66 billion naira. According to the trading performance report from the Nigerian exchange, the all-share index decreased by 122.36 absolute points, representing a dip of 0.23%. to close at 52,186.52 points. Similarly, the market capitalization lost 66 billion naira to close at 28.142 trillion naira, and the downturn was impacted by losses recorded in medium and large capitalized stocks, amongst which are the Nigerian Breweries, Nigerian Exchange Group, Nigerian Aviation Handling Company, NACO, Guaranteed Trust Holding Company, and also O&O PLC. Stock analysts also expect cautious trading as players digest the rate hike outcome of the Monetary Policy Committee meeting, as markets expect more earnings and reports as well as interim dividend later. Now, shifting focus to the international front as well, the European Central Bank is set to raise interest rates for the first time in 11 years today, with a bigger than expected flag move seen as increasingly likely. Policymakers fear losing control of runaway consumer price growth. With inflation already approaching double-digit territory, it is now at risk of getting entrenched above the European Central Bank's 2% target, requiring rate hikes even if that slows or crashes an economy already suffering from the impact of Russia's war in Ukraine. But policymakers appear far from united on just how fast the ECB should move, with some arguing that it is already a long way behind the curve, especially compared to global peers like the United States Federal Reserve, while others point to a looming recession that the European Central Bank risks exacerbating. The bank, until recently, was signaling a 25 basis points increase to be followed by a bigger move in September, but sources close to the discussion say a 50 basis point increase would also be on the table today, as the inflation outlook is deteriorating fast. And now Russia has resumed pumping gas through its biggest pipeline to Germany today after a 10-day outage. And that's according to the operator, easing Europe's supply concerns amid an economic tit-for-tat with the Kremlin over its invasion in Ukraine. Europe has been on edge about the restart after the annual maintenance of the Nord Stream 1 gas pipeline, which accounts for more than a third of Russian gas exports to the European Union. Russia has been curbing gas supplies to Europe for months now amid a dispute with the West over sanctions imposed on Moscow for the February invasion. The reductions have exacerbated an energy crisis, sending gas prices rocketing and also putting the region at risk of rationing and shortages as it seeks to refill energy stores ahead of the winter season. Nord Stream 1 transports about 55 billion cubic meters of gas per year under the Baltic Sea and has been offline since the 11th of this month. And wrapping up business news now, oil prices on the international market have been volatile as traders have had to square tighter global supply because of the loss of Russian barrels following the country's invasion of Ukraine, with recessionary worries that could weaken energy demand. US West Texas Intermediate crude recorded a price decline of 0.93% to sell at $98.95 per barrel. Brent crude now sells at $106.10 per barrel, registering a downward price margin of 0.79%. Bonolite's performance is still trading in the red zone as well, recorded a price drop of 3.25%, selling at $118.10 per barrel. And for the OPEC basket, crude oil dealers offer $110.30 per barrel, with a price surge of 1.39%.